The economy will crash in 4 months. I'm your host, Steve Van Metre, and thanks for joining me today. Famed tech manager Cathie Wood is back in the news saying that we're in a recession and the Fed will be forced to cut rates next year. And of course, as we know, the Fed only cuts rates when the economy's crashing. Let's head over where we picked today's story up as Cathie Wood again insists we're in a recession, says the Fed will cut rates next year. We believe we're in a recession. 2 consecutive quarters of GDP declines is the beginning of that definition, she said in her interview with Bloomberg Television on Monday. 3 consecutive months of declines in leading indicators, which we have now, would suggest the same. I know a lot of people are focusing on Friday's big employment gain in non-farm payrolls, but if you look at the household employment, which is a much broader-based survey of employment, that has been flat to down over the last 4 months, Wood said, and this is something that was echoed by our chief strategist Jeff Snyder in a recent interview and in his deep dive reports when I went over and visited him and Emil Kalinowski on their channel. As Jeff said, the household survey has been in decline, and that means a mean reversion is coming for the non-farm payrolls. Wood's comments to Bloomberg on Monday echo statements made during an interview with CNBC in which Wood indicated the economy is in an inventory-led recession and job growth is set to slow. And there's some truth to that, because if we look at retailer inventories, we can see they're surging higher, and not just higher, they're past their peak of the pandemic highs and seemingly continuing to go higher. But when we overlay, and this is interesting, the 4-week moving average initial claims in red, we know that usually rising inventories aren't an issue. As long as people can continue to afford to buy goods, it's not a problem until it is. And once you reach that point where wages are not keeping up, where people cannot afford all of these goods, well, that's when inventories start to head lower and unemployment claims start to head higher. Let's head on, as Wood also pointed out, to a rise in weekly jobless claims, which have hovered near an 8-month high in recent weeks, and company layoff announcements as signs the economy is out of step with recent job figures, as we pointed out on the show many times. We're getting all kinds of signals that the economy is very weak, she said, and while most economists are saying the inverted yield curve points to recession maybe next year, we believe we'll be coming out of one next year. Of course, the only question is, for Ms. Wood, is when next year, more likely at the earliest point toward the end of next year, because a yield curve, which is a 10-year treasury minus a 2-year treasury yield, has an 85% probability that we are heading into a recession, and suggests that that is indeed coming next year, as economists are starting to predict. And what it means for, of course, the Fed, as Wood said, she expects the Fed will begin ushering in interest rate cuts next year, a comment that comes as Wall Street prepares for the U.S. Central Bank to continue raising rates aggressively to combat inflation. And of course, we know that's true because when we invert the yield curve, which is an excellent predictor of what the Fed is going to do, and we overlay the federal funds rate, it indeed does predict that, of course, something is coming. And again, this is our chief strategist who predicted this. Something by the end of this year or early next year is going to cause the Fed to pivot. Doesn't mean they don't hike in September. It means something is going to change, and the bond market is already telling us that. In fact, we have some even bigger news on the inflation front suggesting the Fed is heading in the wrong direction. As consumers' U.S. inflation expectations drop across all-time horizons, as median 1-year ahead expectations fell to 6.2%, the 3-year to 3.2%, as a shift in outlook comes after weeks of falling gasoline prices, a case that we've made on this show many times. The drop in gasoline prices over recent weeks played a big part in easing household concerns, as the New York Fed survey found that consumers now expect gasoline to rise by just 1.5% over the coming year, down more than 8 percentage points from March. There's also a sharp drop in expectations for food price inflation. And sure enough, you don't need a PhD in economics to figure this one out. Here's the University of Michigan inflation expectations in blue, overlaid the U.S. regular all formulations gas price in red, saying, as we know, that there is a high correlation between inflation expectations and gasoline prices. And as gasoline prices start to come down, well, that means inflation expectations come down as well as interest rates. And of course, that also is bad news for the stock market. But yet, there's one strategy that can hedge, of course, those downside moves with interest rates, and that is Portfolio Shield. I'll put a link up here in the corner and the description below, because as interest rates go down, bond prices go up, and it'll hedge that. Now, the question you might ask is, how can gas prices be going down, or could they go down? Because the case for energy is bullish. Well, think about this. Energy and gasoline is used such widely in our economy. How do consumers use the most gas? Well, when they do it, when they commute. If you lose your job, you're not commuting, and we'll make the case that more of those are coming soon. But what about in an inventory-led recession? Well, a lot of goods, of course, raw materials as well, are moved, of course, by gasoline. And if you have too much inventory, you have fewer orders, fewer things moving, and sure enough, you have the case why gasoline prices come down. Let's head over to our chief strategist, Jeff Snyder, who weighs in on the Fed's New York branch of Survey Consumer Expectations in his daily today. He notes that consumer views on prices are largely shaped by those for gasoline and food. True enough. And results of the Fed's own survey data continue to show widespread expectations for much less aggressive consumer price increases in the future. If you want to hear more about what our chief strategist has to say, click the link for Markets Insider Pro in the description below. Free for a limited time. And more signs that we're going to see a downturn in the economy come today from the National Federation of Independent Business Small Business Optimism Index, which remains just around pandemic lows, suggesting that small businesses are not optimistic at all, because on the inflation front, we're about to see a change in inflation. Now, we might still get a hot print here on Wednesday, but look for a peak in inflation. If it's not already in, it's pretty close, because the labor market is starting to suggest that. And check this out. We have the preliminary non-farm productivity is slowing down from -7.4 to -4.6, so it's an improvement. Unit labor costs, also preliminary data, coming down from 12.7 to 10.8. Now, productivity, just before we get to these next charts, I want you to understand is how productive an employee is. Now, when you hire someone new on the job, they're not real productive compared to, say, someone who's been there a year or 10 or even 20 years who's very productive. And of course, as someone becomes more productive, you actually end up paying them less, because when you're desperate for employees, you have to raise wages to get people in the door. So check this out, as we're going to see inflation expectations likely to continue to come down, led now by the labor market, as non-farm business sector labor productivity in terms of output for hour for all employed persons in left in blue on a year-over-year rate of change against the consumer price index in red, also on a year-over-year rate of change. And you say, well, I kind of, maybe there's a relationship here. Well, let's invert, of course, the labor productivity in blue, and what you see there is a pretty decent relationship between the two. And it starts to make sense, of course, if you have employees that are becoming more productive. Well, you don't need as many employees, because when you're desperate for employees, maybe you have a job that needs 2 workers and you can't find 2 skilled workers, so you hire 4 unskilled workers. And what happens over time, you find out that 2 of them are better than the other 2, and they're becoming more productive, and you end up laying off those other people, and then you see productivity numbers start to rise, and we're already seeing that. And of course, that then in turn means that, of course, initial claims are also likely to head higher. And we see that in cases where we see drops off of the productivity, you see that start to drop off. And then as it starts to move higher, what do you see from those moves higher? You see unemployment start to rise. And again, suggesting that employers overhire. And then, of course, they turn around and lay off those who don't meet the cut. Now, we also had unit labor costs. And notice this is a very tight relationship with inflation. And you see as unit labor costs are rising, and workers can afford more, driving consumer prices up. But the longer they're in those jobs, the more productive they get, you see unit labor costs come down. So the question is will Cathie be right? Will we be coming out of recession next year? Well, probably, but most likely not till later next year at the earliest, because it's not until the economy is crashing along with stock prices does the Fed actually pivot and start to cut rates. And as we know, stock prices don't bottom until the Fed's done cutting. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.